Hello everyone and welcome to another edition of the Money Pros. I'm Oliver Tutt, Certified Financial Planner Practitioner, and I'll be your host for the next half hour as we talk about all the issues related to your money. How to make it, how to keep it, and hopefully how to help it grow. So we've got a lot to get to on today's show. Let me give you a little rundown on what to expect. First off, we're going to be talking about I think a very appropriate topic for the cold winter months, which is best places to retire internationally. And I promise you none of them are in ski towns. So I'm going to have that list for you and how it was developed by a leading publication. We're also going to be joined by none other than Steve Tetzner from Homestar Mortgage. He is our mortgage money pro, and we're going to be talking to him about interest rates because after the election, the presidential election, we saw some significant changes with interest rates, and obviously that impacts the mortgage market. So we're going to talk to Steve all about that. Making the news recently is a new proposal from Rhode Island Governor Gina Raimondo designed to help make college more affordable for Rhode Islanders. And of course, college funding is a hot topic on this show, so we're going to want to let you know the details on that. And then finally, we have a viewer question that we're going to tackle at the end of the show. So we've got a lot to get to. Let's leap right into it. And the first thing we want to talk about is a new list that's out on the top countries to retire in for 2017. If you ever thought about leaving the borders of the United States, and that may be on more people's minds than normal lately. So we've got a list for you on those places. It's kind of interesting. This is an email that got tossed around among my friends. I think this becomes a very key topic when the weather turns cold outside. We all start thinking about where we want to retire and where it's going to be warmer. So this list comes from International Living magazine, and for the past 25 years they've been creating something that they call the Global Retirement Index, where they rank countries on a variety of criteria, including cost of living, climate, the quality of health care, friendliness to foreigners, a whole slew of different things. And then your total score develops their ranking, and they rank actually 25 countries. We're just going to cover the top 5. So without further ado, let's talk about them, and I'll give you a little rundown in each one of them. Number 5, this one came as a little bit of a surprise to me. Number 5 is Colombia, apparently not just a haven for drug lords anymore. But the magazine noted that Colombia is known for its lush beaches, colonial towns, and apparently very welcoming to foreigners, particularly in the villages and outlying areas. So Colombia, number 5. Number 4, Costa Rica. This is becoming an increasingly popular vacation spot as well. The magazine notes that Costa Rica is number 1 on its list for inexpensive quality health care, and that's going to be a key factor if you ever decide to retire out of the country, because most U.S. health insurance is not going to help you out of the country. You're going to have to depend on the local health care. They also note that in Costa Rica, it's very easy to obtain residency, which obviously would be a key factor, and they note specifically the very low cost of living in Costa Rica. All right, number 3 on the list, Ecuador. Would not have imagined. Ecuador. These are all in South America, by the way, I would point out. But Ecuador, they noted a very large expat community. Apparently, this has been a place for U.S. residents to move to for a long period of time. So there's a very large contingent of ex-U.S. citizens down there, or people that are from the U.S. down there. They note that Ecuador has excellent programs for its seniors, including significant discounts on a variety of things once you turn 65 that you would qualify for if you return down there, and noted Ecuador's beautiful weather. Number 2, Panama. This is an interesting one, but a lot of this makes sense. So the magazine notes with Panama that it is actually a global crossroads. Obviously, because of the canal, there's people from a variety of countries in and out of there on a daily basis. So Panama is very, very welcoming and accepting of foreigners. It's been part of their culture ever since the first canal was attempted to be constructed, I believe by the French, until the U.S. finally sorted it out, and noted Panama's excellent infrastructure, so roads, bridges, things along those lines, shopping, all of those things that some of us have come to expect from living in the United States. And then finally, the number 1 country. That's right, don't move to Mexico, don't move to Canada, move to Mexico. Now, most of us would think of Mexico, a lot of the news about drug violence and things like that, but the magazine notes that that is really confined to some very specific areas. Mexico's a big country, notes the very low cost of living in Mexico, excellent health care with many Western-trained doctors, or mostly Western-trained doctors, and varied climate and topography. So you want the tropics, you want the desert, you want mountains, lakes. Mexico has all of those things to offer. So if you're getting cold, you're thinking about retiring somewhere south for the winter, there's some considerations. All right, up next is going to be our mortgage pro, Steve Tetzner with Homestar Mortgage. We're going to be talking interest rates, so stay with us. Welcome back to the Money Pros. I'm joined now by our Mortgage Money Pro, Steve Tetzner from Homestar Mortgage. Steve, interesting goings on in the interest rate market, right? With the presidential election, and so we talk about interest rates from time to time. We're going to focus on them in today's segment. Before we jump into the whole topic of interest rates, though, here we are at the beginning of 2017. Just wanted to get your thoughts on what you thought of 2016 from a mortgage and real estate standpoint. Good, bad, indifferent, what'd you think?
I thought it was a phenomenal year, especially if you're in the mortgage side. The purchase market, people buying homes, was robust. We saw great growth here in Rhode Island and in the Northeast. And we also saw a low interest rate environment, which also gave an opportunity for some refinance activity. So between the two, our company had a wonderful year in 2016.
And that's the report I'm getting from most people I talk to in your industry, that 2016 really represented a marked recovery from, the 2008, 2009, probably the bottom of the barrel there. So we want to talk about interest rates, and I think there's probably no better way to do that than to look at what happened to rates over the course of 2016. So you've provided a graph for us that we're going to put up on the screen. So let's put that up, and let me have you talk about the story of interest rates over 2016. And obviously there's a notable leap there in November that coincides with the election.
Correct. So, if you look over the course of, this is basically a one-year look at what the average 30-year mortgage rate was, you'll see that the rates were, pretty consistently under 4% going through the year. The economy was not very strong from a lending perspective. So when you don't have a super growth, interest rates stay low. You have a low interest rate environment. Even with the purchase market, interest rates stay, trended low throughout the majority of the year. And then you can see in that November, and if you could actually, bring that down to a 1 month, shrink it down, you would see that spike is about a 1 week spike in interest rates right after the election. Mortgage rates went up on average almost 0.75% from the day after the election till about a week to 9 days after that.
So I want to talk about a couple of trends here, and the notable one obviously is the spike after the election. But one of the other things that I find interesting is we started 2016 with 30-year rates in the high threes, 3.8% approximately, and we see a decline from there through the summer. Now, you and I have been having conversations about interest rates as long as you've been on this show, which is since the beginning, essentially.
Right.
Longer than either one of us wants to remember. And we're seeing interest rates going down there, but every conversation we've had is talking about when interest rates are going to go up. In a lot of ways, 2016 was surprising, but that's one of them. They kept declining, right?
If you look at what happened in the markets, in the bond markets, we really didn't see a lot of activity with that. We didn't see a lot of economic growth that was causing the rates to go up. And then we saw a couple of Fed increases, which actually sometimes is good for mortgage rates because it shows that the Fed is paying attention to inflation. So people are more willing to invest in bonds because they know that their yield is going to be controlled, and their profit will be controlled because the Fed's paying attention to inflation.
Now that's an interesting point that you make, and I was actually going to ask you that, is we talk about what drives interest rates being essentially the secondary market and what goes on in the treasury markets, right, which is a matter of supply and demand. Contrary to popular opinion, that is not just the government simply setting rates, but the Federal Reserve does set certain important short-term rates, and you're saying that did have a little bit of an impact on the mortgage market to some extent.
A little bit, yeah. In the first mortgage market, with the Federal Reserve, I think there were 2 increases last year. And it just shows that they were concerned about inflation, and we saw long-term mortgage rates fairly moderate, and we didn't see a lot of growth. I don't remember, I think the growth for last year was definitely under 2.5%. So if you look towards the election, now that the markets all of a sudden are thinking, okay, the economy is going to be robust, it's going to grow, we're going to see deregulation under the new administration, we're going to see policy changes, and the markets reacted, and the interest rates jumped up very quickly.
So that's exactly the other thing we want to talk about on that graph. The most notable feature of that 1 year period was the interest rate jump from right after the election to just even a week later. Can you talk about specifically what happened to rates, and then let's talk about the reasons for that based on the election?
Well, I mean, interest rates went up 0.75%. I'm not sure what more to say than that. That's the way the markets reacted. I mean, we saw a huge rally in the stock market, and typically mortgage rates will follow the stock market. So if the stock market's going up, interest rates are typically going up. And we've talked about this before. How where's the money flowing? If it's flowing into stocks, then it's coming out of bonds. When the price of the bond goes down, the yield goes up. And that's basically what we saw over that time frame. We saw a huge investment into the stock side, and we saw the yields on treasuries and on the mortgage bonds spike.
And I think this is a great lesson for investors as well as borrowers, which is we often talk about, particularly in the short term, the inverted relationship between stocks and bonds, right? So we see that with that graph. People need to keep in mind that spike in interest rates meant that bond prices were dropping.
Correct.
So that as an investor in bonds, that was hurting your portfolio to some extent. But on the flip side, you were also taking advantage of spike in the equities. So it's
Correct.
kind of exactly what we talk about. And so it's interesting to be able to point to a graph and talk about that. Any differences between because different types of borrowers are looking at different types of loans, difference between home equity loans for people that are maybe looking to fix up their house or do something else versus first mortgages, and if there are differences in those rates, why are there differences?
Well, it's two different supplies of money. So the mortgages are mortgage-backed securities. That money's coming from the secondary market. It's basically Wall Street. It's the same as if people who are investing in treasuries. Home equities is a different supply of money. That money is coming through the banks. That's bank deposits. That's money that's coming from the Federal Reserve when the banks borrow the over-the-counter rate, which is what the Fed controls. So that is typically variable rate money. That is the money, the interest rates that affect what you're going to pay on car loans, what you'll pay on your home equity products, which are your second mortgage products, and any type of personal borrowing with the bank can affect credit card interest rates, things like that.
Interesting. So the home equity loans are almost more along the lines, I think, of what people probably traditionally think of as a mortgage, where that money is coming from the bank and depositors, whereas really first mortgages is coming from the secondary market, as you point out.
Correct.
Tough question for you here. Now, I wouldn't be doing my job if I didn't ask,
Okay.
But if you tell me, I can't tell you I understand. Do you have any sense of what is going to happen in 2017 with interest rates? I mean, do you think it's going to be more increases, or what do you think?
I think interest rates are going to go up. I think that we're going to see 30-year fixed rates settle in by the end of the year somewhere between 4.5 and 4.75 would be my guess. We'll revisit this show, I guess, in January of 2018 and see how right I am.
That wouldn't be fair to do, only because I've made prognostications about the stock market that have not always proved correct either, so I can understand that. But I guess the next follow-up question to that is, if interest rates do go up, and they already have to some extent, have you seen any chilling effect on home purchases? Do you see that maybe happening in the future, or do you think that will encourage buyers to say, hey, I better pull the trigger now?
Movement in interest rates always spurs the market. What you have to remember is, what's the reason that interest rates are going up? It's because the economy is growing, it's robust. Interest rates have less of an effect on people buying homes than their confidence in the fact that, am I going to have a job? Can I afford the home? And is my income going to grow over the next few years? If people believe that they're confident, or that they feel confident in their financial situation, they'll buy homes. And history shows us that. If you look back to the 1980s, interest rates were double digits. Home prices were going crazy. People were buying houses like crazy. So I think that the interest rates have far less effect on the purchase market than the economy does.
It's, I think part of what you're saying is it's a lot about consumer confidence. If people feel good about their jobs, about growth, about their long-term prospects, they're not going to let a percentage point or more in difference in mortgage rates between now and 6 months ago change their plans, right?
Correct.
Another interesting impact sort of a little bit outside of the specific economic realm, but of the presidential election, has to do with regulation. And many people believe, and it's proved to already be the case in some areas, that President Trump will roll back regulations in a variety of areas. Do you see that happening in the mortgage industry? And if so, what are some likely targets and how will it impact your business?
I hope so.
Okay.
Our industry is very heavily overregulated right now. The pendulum, I've been saying, is swung far too far to the right now. We need to bring it back more to the middle, a little bit more common sense in lending. Some of the regulations under Dodd-Frank are really causing havoc in the lending industry. It's preventing banks from making loans that are good loans that they want to make. But because of the regulations and fear of the CFPB, the Consumer Finance Protection Bureau, and the unbelievable authority that they have over us, banks are scared. They're scared of the enormous fines that are being levied. So they're really not lending money in cases where they should be. And I'm not talking about all the crazy lending that went on in the early 2000s. That stuff didn't belong in the market, in the derivative markets. I'm just talking about common sense, good, solid lending.
So President Trump has been in office for less than a week as we tape this, but significant impact potentially already on your industry and more to come. So it's something that's going to be worth following as we have you back.
It's going to be an interesting year.
All right, Steve. Thanks as always. Great information. All right, up next, we're going to be talking about college affordability and a new proposal from Governor Raimondo. So stay with us. There's more to come here on the Money Pros. Welcome back to the Money Pros. Interesting news made that I thought was very important to talk about on this show. This is sort of a pet topic of the Money Pros, which is the subject of college affordability. We've talked many times about how expensive it is, the debt load that many students are saddled with, and what to do about it. And recently, as part of her 2017 budget, Governor Raimondo made a somewhat unique, in fact, we'd only be the second state in the country, proposal to pay for at least part of Rhode Island residents' college education. So this is part of her 2017 budget. It would obviously have to be passed by the General Assembly, but it's a pretty significant proposal, and I wanted to talk about it here on the show. So the governor and her office notes a few things as part of this proposal. One is something we've talked about before, the rising cost of a college education. It's risen far in excess of the rate of inflation and has become cost prohibitive for many American households to pay for. They also note that more and more positions in Rhode Island require not just a high school degree, but also a college degree. So if we want to be able to hire Rhode Islanders for those jobs, they're going to need a college education. And finally, they note an issue with persistency with college students who enter college but do not complete it and get a degree, oftentimes because it becomes too expensive. So her proposal, which they've called the Rhode Island Promise Plan, is an offer to essentially pay for 2 years of college education for Rhode Island high school seniors. So let's talk about it. Let me throw up a slide and we'll talk about the important points. First off, it begins with the class of 2017. So if you're a senior now, you would be eligible for this program. If you graduated in the past, you would not be eligible. And if you never entered college, perhaps, you would also not be eligible. So it's class of 2017 or later classes. Next, the proposal offers to pay for 2 years of a college education. So that would mean potentially a free degree at associate's degree at a place like Community College Rhode Island, CCRI, or the offer to pay for 2 years at Rhode Island College or URI as part of a 4-year degree. Now, if that's the part of the offer you're taking advantage of, it would be the last 2 years or your junior and senior year. The state would not be paying for the first freshman and sophomore years. Next, the residency test, meaning you have to be a Rhode Island resident to qualify, and it only qualifies for Rhode Island state institutions, RIC, CCRI, and URI. The residency test would be the same test that you would have to meet in order to receive in-state tuition at any of these institutions. There's no needs-based testing. So this is not financial need-based. While you will have to fill out a federal financial aid form, the proposal does not stipulate any particular income or net worth thresholds or anything like that. All students would be eligible. And finally, there are no repayment scenarios. So if you do a year and you don't complete the degree, or you go into a field that's not what you studied, you would not have to pay that back. So this is a significant proposal. It's something that definitely bears watching to see if it's passed by the General Assembly. So far, the reception has pretty been good. I'm not sure if policy-wise this is the right way to do it or the wrong way. I'll keep my thoughts on that separate for the time being, but I will say that I applaud the governor for at least taking some steps to address what is a significant problem for Rhode Islanders and people across the United States. All right, up next we're going to tackle a viewer questions, so stay with us. There's more to come right here on the Money Pros. Welcome back to the Money Pros. Okay, viewer question time, and this is a common question, so I want to keep answering it until we all know the answer. Viewer writes in, I turned 70 in March. I know I need to start taking money out of my IRA, but I don't know if I need to do it before March or by the end of the year. Can you help? Yes, I can. This is a complex topic to negotiate. I do this for clients all the time because there's a lot that goes into it in addition to the deadlines. But in specific answer to your question, March is not your deadline. Because you turn 70 in March, you do in fact turn 70 and 1/2 before the end of 2017, and that's the critical issue. So you are required to take a distribution from your IRA for 2017. However, your first distribution is not required to be taken until April 1st of 2018. From that point on, you'll have to take a distribution in the calendar year in which it's required. So if you defer until 2018 on your first withdrawal, you're going to end up taking 2 in 2018, which I do not recommend. So my recommendation is take your first one this year, take it any time before the end of the year, and then you'll be on a schedule to take 1 a year thereafter. I hope that helps answer that question. If you have a question for me in the Money Pros, feel free to email me, moneypros@foxprovidence.com. I answer all the questions. And thanks for watching. I hope you have a great day. Thanks for watching the Money Pros. Take care, folks.